Welcome to TradeTheMBI.com. This is John. This report is for the 5th. Well, it's a pretty significant move. Again, above the ABM, things were holding up, but chairman spoke and mentioned that he's still dedicated to trying to help, the administration with lowering interest rates, despite the fact that oil on that isn't giving any leeway. And it's not hard to see that inflationary pressures are going to continue to press. Of course, then you threw in the world events where Israel declared high alert on all their embassies, obviously the Red Sea and that situation, and of course with Iran. Persian Gulf lights up big time, and that kind of fear element certainly going to scare a lot of people in the market, because you could see a significant reduction if there is any hot activity in the Middle East, and pricing isn't prepared for that at this particular stage. So it was an opportunity for taking some gains. We filled the positive extremes, at least from a daily standpoint, completely. We had done so before earlier, but this cleared it. And given these readings, now you have potential of MBI white leading. Now, of course, that's the start of today, so it hasn't quite developed, but we had that meeting point right here at the close from this move. And given where those readings are, difficult to hold that 76% or any support with those kind of readings. Of course, we have rising zero. That's going to be a draw down towards that 50% Morgan Stanley, which is rising at this particular stage. So 51, 31 range, definitely within plausibility. That would get us back to this set of positive extremes right about here, which was a little lower at 78 range, 50-80-ish, just to keep that in the back of your head. From an NQ standpoint, it was already weaker. From a broader sense, it already met the 50% threshold. So that little bit more of a significant move could be enough to generate some excitement. You can see it never dipped below the red line from an extreme. And if we go back and you look at the extreme from a daily standpoint, you can see it's been below the red line, continues to be. So a little bit of a divergence between the two, and that's just because they haven't been running equally, relatively speaking, from a broader standpoint. But at least from a overall reading standpoint, we've seen that the Nasdaq has been weaker, and that's simply because it had a much stronger move. And so that MBI white spike leading to a move down to 50%, working out as expected, and it's pretty powerful when you see it from a daily standpoint. There's no getting around it. Of course, bonds, this is an interesting one, because what we're seeing with gold shouldn't take place relative to the idea that there's going to be easing, in that gold should be heading back, except for the fact that in the real world, everyone can see that inflation is not under control. It's not getting under control. And they're just kind of accepting that. And it's sort of like, let's pretend that it's under control by saying it. And then we can go ahead and ease, which makes absolutely zero economic sense, because the minute you do that, you're just going to have a skyrocket of commodity prices. Now, from a practical standpoint, is the debt sustainable with these interest rates? No, but we talked about that a while ago, that they're between a rock and a hard place, literally getting squeezed right now, because at the end of the day, you can't sustain the debt with the rates that currently exist, given how far it's exploded. And you can't leave it there, because that will lead to an absolute implosion in the ability to spend without printing skyrocketing amounts. And relative to other currencies, that would be a problem. So then you would have serious pain as it relates to the dollar value. But that's not going to stop the commodity situation, and that's the only refuge. And this gets you back towards the early 70s, where you saw real estate prices more than double, and everyone thinks that real estate's expensive now. I don't think it's begun it now. That doesn't mean that there aren't going to be difficulties when there's economic crisis, things like that. But from a long-term standpoint, real estate is going to, and that's the way it always works. Most of the appreciation that comes from real estate is because of the defense against inflation. And sometimes it's an appreciation based on economic conditions, but for the most part, inflation usually is what drives that, and particularly when it was cheap money, that's a form of inflation. So uh, there you have it. From a euro standpoint, ridiculous move to the upside, but relative to the idea that the U.S. is going to ease inside of that. Still no growth in the eurozone. Surprisingly, though, actually, Italy is the only portion of the eurozone that's actually doing okay, relatively speaking. I think there were 0.7 or zero point 0.8 growth, which, depending on your numbers, you can move either way on that, but definitely France, Germany, and them all in the negative side of the column and not getting any better. And then, NATO announcing that they're going to move troops. France is moving troops into Ukraine. And this just gets into that political situation where, they're saying prepare for war. Well, that isn't good for economic conditions in any way, shape, or form. Gold, you see, leveled off, and that typically happens when there's a sell-off day. Liquidations trying to cover it, but it immediately recovered back most of that, and it's going to continue its upside move. There just isn't any question about it because oil isn't going to stop. Uh, Too many concerns, too many risk factors, and that has to be priced in. And the only way to do that is through the added cost per barrel. None of this is difficult to see coming, and that's going to lead to an increase in the rate of inflation. Gas prices are going to squeeze people as well as businesses, and you start all over again. Never mind the bigger energy crisis that's already building with green initiatives and that unable to sustain the current grid, and then the fact that you have AI and everything else that wants to double, triple, and quadruple actually the energy needs that take place. And none of these things can come together without something breaking, and any one of those legs falling apart is a problem, and none of it's being resolved in any way, shape, or form. And that's going to lead to some kind of systemic failure somewhere along the line. The timing of it, eh, well, we can look to the charts because the bigger money is going to start to see that going through, and we'll see that in our readings. From a Bitcoin standpoint, it held up nicely. In fact, did quite well despite the sell-off, and that's an indication that it's going to be seen as a refuge from a lot of people, and that definitely is an important element because that is a alternative where gold was maybe one of the few that you had, or moving into petroleum as a hedge against those kind of things. But this definitely creates an outlet. Is what I would refer to it as, an outlet for where resources can go. From our standpoint, the view on the chart, not all that complicated. We basically came back, filled positive extremes that came all the way back into the end part of March, and then this last move after the market close took us all the way back to the beginning of March, filling this positive extreme back here, which was the initial breakout. It also satisfies the dip below the red line. All in all, not too bad, for what people would consider to be a dramatic move. Not really. We had the precursor of it here with the NBI white spike that didn't lead to a move back to the 0 point. So there was the divergence. The secondary NBI white spike came through, and as soon as the sell happened, which corresponded exactly to DOC spread, perfect timing, both of those, and you saw the move to the 0% plus because NBI white stayed in the lead. Pretty clean. No argument with that whatsoever. Intraday, that's what it looked like. Once that started to realize the systemic risk that existed, risk off, and boom. And of course, we figured in the aftermarket where things were lighter, they'd be able to push it. And again, I've talked about this before. Some of this volatility is going to start to skyrocket simply because a lot of what's being traded these days is options. And we've been going over this for the last several weeks and even months before, when I was mentioning that that increased in option volume, you've got to get rid of that the gamma situation in that. And from a dealer standpoint, they're having to buy calls to counteract the number of puts or vice versa. And they need to move by buying actual stock in that accordingly or selling it. And in this particular case, you wipe out all the longs in this thing. And when that happens, though, you're wiping out those positions completely because it's a zero sum on option plays. So how long that can last? Well, it's going to dry up a lot of the liquidity, and once that's gone, you're going to move more back to just actual stock purchases. The reality is that the stock prices in a lot of cases have gotten very high. A lot of these companies haven't split or done a lot of the reverse splits that they typically would do to keep the price range reasonable. So it's relatively less expensive to move into the option world from that standpoint. So you might see a normalization of that where some companies realize that it might be better to actually have a reverse split so that they can get down to a more reasonable price point that will allow more active trading, and it just that would definitely change things as far as improving liquidity. We'll see if it takes place. Usually takes a while for that kind of thing to work out. From a current standpoint, though, looks like we might get a little bit of ease back in there, but overall, I think that the action is pretty self-explanatory, and I think that it'd be difficult for them to hold the early gains as it is now. If they're able to, that might be enough to stabilize the readings, but if we continue to see selling, it's just going to keep going towards that 50% on the daily chart. We'll see it here on 5K first, or even 5-minute, and then definitely in the 50K chart. That's the long and short of it for now. As always, trade well. We'll talk again later. Have a good one.